Coming up today, stocks finish higher as the Trump put kicks in, bearishness returns. Is the bank scare already over? Gold pulls back. Is New York turning communist? What could be the potential alternative? And is the stock market on the cusp of a watershed moment? It's been an unusual week, guys. Let's go. And there we have it for the week. Quite a few things going on out there today, as they have been all week. We saw crypto finish weak again. Gold and silver actually come off a little bit today, along with the miners. Small caps finishing lower, but most other sectors, including regional banks, the best performing today. And I'll show you all of that on the charts, along with some interesting stats, as the market was a bit dicey coming into today's session. It did have a chance to sell off hard, but it didn't, and it's actually been a bit of an unusual week with the VIX very elevated, whilst the market is just below its all-time highs. And one of them will prove to be right. Either the stock market will fall or the VIX will fall. And so we could be heading for a bit of a stock market watershed moment. Or did we just see the storm before the calm? Looking at the VIX term structure here, early this morning, very elevated up the front. Option dealers pricing in a lot of volatility for the here and now, and you can see how much that's jumped from just Wednesday. And so that setup with the S&P within 5% of its all-time high and the VIX above 20 can be a late stage signal, something we can see at the tops or on the way to the tops. Like I said, when volatility pricing increases along with the underlying asset, that's a sign the market is pricing in a correction. And I guess the good thing for the here and now is this pattern's only really just started, and we've seen in prior melt-ups, it can go on for some time. As we approach the 38th anniversary happening this Sunday, the 19th of October, where we saw the largest one-day percentage drop for the stock market back in 1987, 22%, which no doubt got nerves flowing, but not all that surprising. What we also got this morning was the Trump put, with the president saying no when asked if China tariffs will stand. Saying an extra 100% China tariff is not sustainable. Like we've always said, it's a negotiation tactic. And we've heard that Scott Bessent is actually going to speak with his Chinese trade counterpart tonight. In another good sign that tensions could be de-escalating and they're making progress on their way to an official new trade agreement. It's also just been confirmed that Trump and Xi Jinping will meet in 2 weeks, just as Polymarket is pricing in now. Again, another good sign, along with the bounce back in market pricing, that we will see a new agreement between the world's 2 largest economies within the next 2 weeks before the November 10 date, which the 90-day extension expires. So I agree with Tom Lee. I understand why markets are wary. US and China tension, major deleveraging, so-called cockroach fears on private credit, October being the most volatile month of the year. But on the positive side, we are seeing bearish sentiment come back, which is a good contrarian signal. And only 22% of fund managers are beating the benchmark this year. Along with Wall Street in general still having their year-end price targets below the market, that could set up for a year-end rally, especially if we do get a blockbuster US-China trade deal. We'll take away those fears, and Tom Lee could be right to buy the friggin' dip. And there's a look at the latest AAII Investor Sentiment Survey, sharply flipping back to bearishness. We haven't seen that much bearishness versus bullishness in quite some time. Along with the fear and greed index just climbing back into the fear zone from extreme fear yesterday. Still plenty of nerves out there, again with the market just sitting below all-time highs, which I'd say overall today, pretty positive price action. We gapped down, got the Trump put, and then the market kind of rallied into the close. Interesting to note my S&P 500 oscillator, which looks underneath the hood at the market at a lot of internals, currently sitting in oversold territory, even though prices are not that far off all-time highs, meaning technically the market's showing signs of a short-term bottom. And so like I've been saying, this big red candle from last Friday is still in play, but we just briefly bounced off those lows on Tuesday, kind of spent the whole week consolidating, and I guess it all depends on how this US-China story plays out. But if all positive, then we should be taking out these highs. Unless we see something major negative develop, then I'd say we take out the lows. But that was a huge volatility crush today, after the VIX gapped up to 28, almost getting to 29, finished at 20. So if we didn't get those Trump comments seeking to de-escalate with China, we very well could have had a different day out there in the market with the VIX going above 30. But again, the deeper the market sells off, the more likely the president will step in and say something to support it, which does affect the market. But what about the bank scare? Talk of there's never just one cockroach in the kitchen, as we saw some regional banks declare some losses yesterday. Well, at this stage, I just think it's fears over headlines. According to Moody's, they think the banking system and private credit markets are sound despite worries over bad loans. With their head of global private credit, Mark Pinto, saying one cockroach does not make a trend. And one of the largest regional banks in America, Fifth Third Bancorp, said there's nothing to worry about, and their provisions for credit losses were less than feared. With them coming in with a slight beat, stock finishing up a little bit as well. And like I said yesterday, I expected the regional banking sector to find support today, and it was actually the best performing sector across the market. As I think yesterday's headlines around Zion and Western Alliance kind of just drummed up renewed chatter about a credit contagion like we saw a a couple of years back. I think at this stage it's largely idiosyncratic. It's not indicative of broader systemic deterioration. I mean, we're talking about a $50 million write-off on a company that's got a market cap of $7.3 billion. And so even though it makes for great headlines, it's pretty much a nothing burger relative to their balance sheet. And large banks' quarterly results, not only beating on earnings expectations, but they've not signposted a surge in non-performing asset or extra provisioning for large credit losses or anything like that. So it doesn't look like a looming credit crisis. Deposits are stable. No doubt there's a little pressure in commercial real estate, which does look contained, but it's understandable why the market anxiety is a little high at this stage. But there is no current indication of a material credit meltdown, with credit spreads still quite low, just a few little pockets of stress. No doubt some rising delinquency rates amongst high-risk borrowers, student debt and the like, but I think the current downside risk from all that is isolated and limited rather than system-wide and structural. And plus, we're already getting the famous magazine cover indicator, which generally proves to be a great contrarian signal because it's indicative of peak sentiment. And it's quite surprising how quickly that these small loan losses from regional banks, which you can pretty much find in any year, has sparked calls for concern. What's far more important is how much money big companies are making. Still early days in Q3 earnings season, with only 12% of the S&P 500 currently reported, but 86% of them have reported an earnings per share surprise. And so far, the growth rate, 8.5% year over year. Those two numbers continue to hold up. Looks like we're on track. Another great quarter of earnings, helping to justify currently elevated valuations. Got a few big names reporting next week. Netflix and Tesla will be ones that I comment on. I'm expecting Tesla to beat. I'm actually betting on it in Polymarket. I think there could have been a rush of people looking to get electric vehicles, locking in expiring tax credits. I also expect their energy and storage businesses to come through with healthy beats. There just may be a risk of increased capex as they're rolling out robo-taxi and making more investments into Optimist bot that may indeed cause them to miss on earnings expectations, even though they're likely to see some decent performance in their key categories. Just moving on to gold, saw a bit of a pullback there today, which it's easy to see on the daily chart. Quite a heavy looking candle and actually an all-time record trading volume day. After we're getting photos from all around the world yesterday of regular everyday people lining up to buy physical gold, we're continuing to get more and more today from cities all around the world. People seeing the price of gold going up, and they need to get in on the action quickly. With a lot of activity in Asia, here's a packed gold and silver bullion dealer in Singapore, 6:30 p.m. on a Friday night. As it's quite amusing to see these classic market memes play out in the real world. Now got long-term market veteran billionaire Bill Gross saying gold's become a momentum and meme asset. Quite a big call. And what's interesting, gold became the first asset yesterday to hit a $30 trillion valuation. No other asset has come even close to that. Bitcoin's just a bit over 2. Nvidia, the world's largest company powering the AI boom, not even 5 trillion. And so when you think about it, gold is little more than a nice shiny rock. If you had $30 trillion to invest, would you want all the world's gold, which is a non-productive, non-yielding asset? Because if you plowed your entire 30 trillion into that, you would have no yield, unlike a property, a farm, a business that produces income and earnings that can be reinvested. Like Warren Buffett says, it's pretty to look at, but it doesn't actually do anything. If I had the option to invest $30 trillion, I would much rather own 10 alphabet Googles, which I consider one of the most quality companies in the world. For just 10% of gold's market value, you get ownership of 90% of all global searches. And YouTube, the most dominant form of content creation and consumption across the entire world. You also may not know it, but Alphabet Google also owns 14% of Anthropic, who are behind the Claude chatbot that is actually powered with Alphabet's TPU chips. Alphabet also owns 8% of SpaceX. They also have the leading AI model Gemini. They're also one of the best global map providers. They own Android, power 3 billion devices, dominate online ads, email, cloud, web browser. The list goes on. Google is the internet. And technically speaking, gold is reaching some limits. It's now up 9 weeks in a row. It's never been up 10 weeks in a row. Looking back in history, after gold's up 9 weeks in a row, it is lower a few days later, a few weeks later, and 2 months later, 100% of the time. And an interesting pattern I noticed on my own indicator, the dynamic swing index, the DSI here in the green. On the gold futures monthly chart, looking at the last major bull market it had in the late 70s, going into early 1980, the DSI, you can just look down here when I hover over the candle, peaked out at 27.8. Fast forward throughout history, it never reached that level again. Each time it ran up like it did back in 2006, the DSI got to 22. Back here in early '08, the DSI got to 23. August 11, the DSI got to 19. And this is my indicator that's an improvement on the traditional RSI as it dynamically adjusts to each asset. There's no hard limit like the RSI, which which can't go higher than 100. July 2020, the DSI got to 22. Fast forward today, the DSI is currently at 27, the exact same level when it peaked out in early 1980. In other words, if gold kept running higher here, that would be different this time, and technically speaking, something it's never done before. And so is this time different? Are all these millions of people around the world rushing out to buy gold now, making a smart move? Is gold still cheap? The US dollar's only off 16% from its highs a few years ago. Gold's up about 200%. It's not all justified from a weaker dollar. No doubt central bank buying has been a big tailwind for gold these past few years, but that can just as easily dry up as it did dial up. We've also got inflation continuing to trend down. Tariffs didn't cause a spike in inflation like Jay Powell and the mainstream media told us. And we've also got geopolitical tensions dialing down after they spent the previous 4 years dialing up. Russian President Putin and Trump are looking like they're going to meet up in Budapest in the next couple of weeks, along with Zelensky, as Trump tries to broker his 9th peace deal, which the Russians may be finally opening up to this time. We even heard from a Russian envoy today proposing that Elon Musk and his Boring company, which builds tunnels, build a Putin and Trump tunnel connecting Alaska and Russia through the Bering Strait. Trump said he'd have a think about it. Fun fact, Russia used to own Alaska, which they sold to the States back in 1867 for about $7 million. So like I've been saying, it'd be a good thing to see repaired relations between America and Russia. Ideally, this tunnel can go ahead and we see a restarting of trade between America and Russia. At the same time, China agreeing to operate on global trade standards as well. Who knows, we may be on the cusp of the highest level of global peace we've ever seen in history. And no doubt that is all bullish for the stock market because it should also help to keep oil low. Maybe Russia can sell oil to America. Because looking at the price action in crude oil futures, it is 100% not pricing in any conflicts or disruptions to the flow of global crude, actually down in the 50s, which is a great thing for the economy, making it cheap to move people and goods around. And so I don't think inflation's a problem. I don't think corporate earnings are a problem. I don't think geopolitical tensions are a problem. What I see as a bubbling, probably more long-term problem is New York City, the current home of global finance, is looking set to elect a self-proclaimed socialist, Zohran Mamdani, currently priced in by Polymarket at 91% chance, as he's done a good job at rallying the working class around a socialist vision for justice. Unfortunately, looking back in history, socialism and its close cousin communism has actually been responsible for more deaths than wars over religion, resources, and territory, looking back over the last 100 years or so. And so what does that do to the home of finance? The New York Stock Exchange, the NASDAQ, companies headquartered there looking to raise finance. Billionaire hedge fund manager and New York resident Bill Ackman has called him out, saying Mamdani has no integrity. Just compare his public statements, videos, and tweets from his recent past to what he claims now. A person with integrity doesn't need to constantly disclaim what they have previously said and done. Gone on to say that he constantly attacks him, but he's unwilling to have a one-on-one public conversation with Bill. Even Elon Musk chiming in on this today, pointing out Mamdani's hypocrisy, as he recently commented that he's never said he wants to defund the police, whereas there's multiple tweets showing that he does. And so again, long term, I do think this is a big deal. Potential for a full-blown communist running the financial capital of the world. And so it looks like he's about to be elected. That could pose a serious threat to the city's standing as a global financial powerhouse. New York's strength comes from confidence. The trust investors, bankers, entrepreneurs around the world have that the city welcomes capital, innovation, and competition. So when a politician openly describes himself as an anti-capitalist in the world's home to capital, and he talks about seizing the means of production, pushes for sweeping tax hikes on corporations and high-income earners, that confidence begins to erode. We've already seen a bit of flight of capital and talent these past couple of years anyway, out of New York into places like Miami and Texas, and this could very well accelerate it. Because even if all of his ideas never pass, the rhetoric alone sends a message that success and enterprise are suspect, and that message has real-world consequences for jobs, investment, and the city's tax base. As New York competes with other financial cities around the world, Singapore, Dubai, Hong Kong, for capital and talent. So if investors start believing that the political climate there is hostile to business, it doesn't take long for deals, IPOs, and headquarters to migrate elsewhere. Because if the city turns against the very system that built its skyline, that's a risk to the entire country. And so that's the thing socialists don't understand. Eventually, you run out of other people's money to spend. And wealth isn't created by dividing it, but rather by innovation, risk-taking, the ability to easily raise finance, low taxes, deregulation, and other pro-business policies. And so socialists waving benefits and free lunches in front of most people's faces is like waving candy in front of a child. It will take it every day, not knowing it's bad for its health in the long term. And so, unfortunately, that hard lesson of history may have to get learnt again. I think at the best, New York will turn into something like San Francisco, as Mamdani looks to not prosecute those that steal less than $1,000, basically permitting small crime, which of course you'll see more of. But in the worst case scenario, I fear New York could turn into something like London, which now has the unfortunate title of being the heinous crime capital of Europe. Now with some crime rates on par with that of a third world country, as I'm not even sure the UK and Europe is even investable anymore. A lot of people I speak to and friends over there are looking to get out. They already said it's too far gone. Because for some reason we've got these woke ideologists in power that are determined to not only destroy European capital markets like they have been, with startup capital, IPOs, and innovation falling off a cliff, but they're also determined to abolish the values and culture that the UK and Europe was built upon. Even Joe Rogan chiming in on it, recently saying it's like somebody is trying to deliberately destroy England. Are we going to see the same thing in New York? And what could be the alternative? Well, a few people have already seen this coming. That's why there's been plans for over a year now to create a new Texas stock exchange, which just got federal approval, looking to begin trading next year. And I think that's a very healthy move to compete with New York and give companies an alternative venue to list. And who knows, within 5-10 years, we may actually see more trading in Texas than New York. If they're still ruled by a socialist leader determined to bring down the capitalists, I think we'll also see a continued flight of capital and talent down to Florida as well, along with growth in capital markets down there. Miami International having a very successful IPO a couple of months ago. The stock already doing very well, and I think Texas Stock Exchange could do as well, adding some balance to America's financial markets and counteracting a new socialist leader there. And speaking of Joe Rogan, if you want to listen to an interesting podcast he recently just did with the CEO of Anduril, the hottest new defense tech company in the States. Really innovative products created by this guy here, Palmer Luckey. He created the Oculus VR that he sold to Facebook. Now he's all in on Anduril and closely aligning with the US government to continue the strategy of peace through strength. And so in the podcast, he talks about their next generation defense playbook, how they're developing Eagle Eye mixed reality headset that overlays sensor data, teammate locations, terrain maps, can see through buildings. It's kind of like bringing Call of Duty to the modern day soldier. Talks about integrating AI, drones. They've got a lot of different military products. It's going to be one of the hottest IPOs when it comes onto the market. Same for sure, there is a big race with China. He also talked about his support for Trump, actually recollecting when he wrote a letter to Trump when he was a kid, saying Trump should run for president. And so yeah, he's a really interesting and smart guy. I recommend checking out the podcast because like I said, his company is going to be a huge IPO, maybe in the next year or two. Also interesting to see Robinhood get more and more into prediction markets. They're watching the huge growth with Kalshi and Poly markets, which I still think will dominate, but no doubt Robinhood will have a seat at the table. They're adding more and more markets as they've got the full support from industry regulators now. And just looking across some other key markets, bond yields stabilizing today with the 2-year finishing up. The dollar as well still holding ground. Cryptos did sell off early morning like equities with the spike in volatility, but things seem to have stabilized for the now on the view that we should still see positive progress between the US and China. We've also got a US government shutdown really dragging on, which I think will increasingly become a problem the longer it goes on, as we could be on our way to set a record. But remember, historically, shutdowns have never caused a sharp sell-off in the stock market. We've actually seen a bit of a rally coming out of them. But no doubt a bit of profit taking out there today in some of the hot themes and stocks, which is to be expected after we've had an amazing run-up. Silver and uranium pulling back. I think a lot of these assets will test their moving averages next week. And volatility will still likely stay elevated, probably above 18 until November 10, till we get confidence that we are going to see a US-China trade deal. But barring any new major surprise, maybe the market does defend this 65.50 level, as we're already getting these technically overbought conditions, the fear and greed index, sentiment surveys, all showing as if we're already at a short-term low, even though we're just off all-time highs. So pretty interesting setup we've got going on here. Along with that sharp pullback in gold, mass buying around the world. As always, financial markets keeping it interesting and challenging for us all, and I'll continue doing my best to break it down for you each day after market close. Thanks very much for sticking with Click Capital. Have yourself a relaxing weekend, and I'll see you guys back here again come Monday night. Cheers.